Good morning. Ladies and gentlemen, thank you all so much for taking time out of your day to be here with us. It's really exciting to welcome you to the 2023 Merchants and Marine Bancorp Incorporated Annual Shareholder Meeting. As is customary, we will begin today's meeting with an update from a renowned economist, Dr. Craig Lewis. For those of you who were able to join us last year at the annual meeting, you got to hear a little bit from Dr. Lewis in terms of his outlook on the economy and his outlook on our company. And he did such a wonderful job, we thought it would only be appropriate to have him back. But to give the proper introduction for Dr. Lewis, I'm going to introduce our company's Chief Financial Officer, Casey Hill, who has an intimate knowledge of Dr. Lewis, actually studied under Dr. Lewis at Vanderbilt. And so without further ado, Casey.
Good morning. As Clayton said, I'm Casey Hill. I'm the Chief Financial Officer at Merchants and Marine Bancorp. It's a great privilege of mine to introduce our economic speaker who is here with us for the second year in a row, as Clayton alluded to. And I should also point out, or would be remiss if I didn't, that in reviewing Dr. Lewis's presentation last year, every single thing that he prognosticated came to fruition over the course of the last 12 months. So it's probably a good thing to listen to Dr. Lewis, as I, in my career, have never seen that happen with an economic speaker. Dr. Craig Lewis is the Madison S. Wigington Professor of Finance at Vanderbilt University's Owen Graduate School of Management and a Professor of Law at Vanderbilt Law School, where he has received a multitude of awards for teaching excellence. He earned his PhD and Master of Science in Finance from the University of Wisconsin and his BS in Accounting from The Ohio State University. His areas of expertise include corporate financial policy, asset valuation, convertible debt financing, corporate capital formation, and forecasting market volatility. In addition to his academic accomplishments, Dr. Lewis also has the distinction of being the former chief economist at the Securities and Exchange Commission and director of the SEC's Division of Economic and Risk Analysis. As a former student that likely tested his patience more than once, I will also add that in addition to all of the accomplishments listed above, he is also a gentleman in every sense of the word and just a wonderful human being. Ladies and gentlemen, please help me welcome to the stage Dr. Craig Lewis.
Thank you, Casey. Thank you for the kind remarks. I'm not sure all of them are deserved, but I'll gladly accept them anyway. Good morning, everybody. Going to be talking about a couple things today, but before I get started, I see we have some students from Mossville High with us today, so welcome to the meeting. I'll encourage all of you to think about Vanderbilt as your choice for college when you graduate, so don't hesitate to apply. But I'm going to talk a little bit about some things that are similar to last year. Did I get it? Yeah. So what I want to talk about is I'm going to take a slightly different take than the presentation I made last year. I am going to talk a little bit about current market conditions and what's going on in the stock markets. But instead of making a lot of forecasts about where the economy is headed, I'm going to talk about some current events, and that is the recent bank failures that have taken place in this space. We've seen Silicon Valley Bank, Signature Bank, First Republic, all basically have failed in the last month or so. And I thought it would be interesting to talk about why did that happen? You know, what caused the problems at those banks? And using that, I'm then going to spend some time talking about what is going on at Merchants and Marine Bank and how does it compare to the banks that failed. And so the way I'll motivate this is I'll develop a couple factors that I think were critical to explaining what happened at those banks. And then I'll say, here's where your bank fits. And I'm going to compare your bank to a set of 16 other comparable banks. And so we'll try to put it in perspective. And I think the takeaway that you're going to have after this presentation is that Merchants and Marine Bank is at the best position of all these comparable companies to withstand what's going on in here. And so when I started this, I had no idea where this analysis was going to go. But when I finished, it was clear that you were ranked number one among all these different banks that I looked at. And then given some of the problems that have taken place over the last day or so with PacWest Bank, I thought I'd show you where PacWest looked relative to these other banks as well. And you'll see that they don't look that good. And so the factors that I was using to rank Merchants and Marines against its competitors shows that PacWest probably was sort of a laggard relative to even the companies that I looked at. So we'll finish up with that, and then I don't know how long that will take, but to the extent that I have a little bit of time left, because I am the former chief economist at the SEC, there's been an incredible amount of rulemaking at the SEC over the past few years since Gary Gensler became the chairman. And in particular, I think that as a shareholder in a public company, you should be interested in what the SEC is doing with respect to how you trade stocks. And there's some fundamental changes that are going to take place in this space, specifically with respect to how you will interact with markets. And I thought you'd be interested to hear what the SEC is proposing to do. None of this has been passed. There's still proposed rules, but there will probably be a move to finalize at least a few of them. So as we go forward, I'll try to figure out how to advance my slide here. All right, so current market conditions. We're going to talk a little bit about where the markets stand, stocks and volatility, and then I'll make a few comments about inflation. Maybe I have to get really close. There we go. So this is where, I don't think that's my first slide. Did I skip through one? There we go. Okay, there we go. So I presented basically this exact same graph last year. And so what I did was I added basically another year's worth of data. And what I'm showing you here is the blue line represents the S&P 500 index, which is a broad-based market-weighted index of the 500 stocks. And what you can see is that if you started back here February 22, 21, I'm not sure why I picked my birthday, but I did. And so we go through, and what you can see is over the year 21, stock markets did pretty well. They came down. There's been a fair amount of volatility in markets over the last year or so. If you look at the end here, sort of steadily coming back. But they haven't performed quite that as well as we might like. If you look at, I put in a corporate bond index, and what you can see is that they tend to move together, right? But corporate bonds have done a lot worse. The next thing I'm going to do is show you basically what happens now when you compare a bank ETF. So this is a portfolio of bank stocks. So how is the banking sector done? And I've also put in Bitcoin, just so you can see how crypto assets were doing at the same time. So what you can see, I think, from this graph is that the banking sector has really performed very similarly over time to the S&P 500, right? So it's performed a little worse, right, recently, but so if you look at what's happened in the last few months, the very right edge of my graph, what you can see is bank stocks took a very large downward move, largely because of Silicon Valley Bank and the failure there. And so while they were performing during the year better than the S&P 500, they took the big hit, but since they did drop in price, they've tracked pretty closely. I think if I extended that out another couple weeks, we would see another drop in that, but there's a lot more volatility in the banking sector than what I think we've been historically accustomed to looking at. And what you can see is that the one asset class that seemed to do quite well when the bank stocks dropped were crypto assets, right? So Bitcoin, Ethereum all went up quite a bit when Silicon Valley Bank collapsed. And so now here's what I wanted to show you this graph. What I've plotted on this graph is, once again, it's the S&P 500 index. The green dotted line is a measure of volatility in the stock markets. It's something called the VIX. And the VIX is, think of the VIX as an index that provides a forecast of future volatility in the market over a very short, like 30-day window. And what you can see is that there's been some spikes in volatility, but interestingly, the VIX index also tended to go up, right around the time that the banking sector had its problems. So market investors are responding to current events, right? And when something bad happens in one sector that causes people to rethink their views on the economy, then volatility goes up in the market. And I think investors appreciated that volatility went up. What was interesting, though, is just how quickly it came right back down more to historical levels, and it's been trending up again more recently. So I think if you look at that, one of the really interesting things that you'll see is that when the market goes up, the VIX level goes down. And when the market goes down, the volatility index goes up. It's kind of making that basic point that I make when I teach my valuation courses, and that is that the investors require a return that compensates them for the risk that they're taking on. So if investors believe they're taking on more risk, the return that you require goes up, and what you're willing to pay for the security, of course, goes down because you want to make that return. So that's the S&P 500. Okay, let's go back here. I'm going the wrong way. It doesn't quite want to cooperate with me. This reminds me of, all right. So I'll tell a little story. This reminds me, Casey, can you somehow just fast forward that one more? Thanks. All right. So this reminds me of a presentation. My son went to a high school in Nashville, right? And they had this speaker, this end-of-year speaker. And the end-of-the-year speaker he was saying his presentation was about how to deal with adversity. And he was saying, he had all these, really nicely prepared speech about dealing with adversity, and his presentation was doing about the same thing mine was. And he got more upset and more upset, and basically undermined his complete discussion by showing how frustrated he became with the technology not behaving for him. So I'm not going to be that guy. So I want to make one quick comment about inflation before I talk about bank failures. And inflation is here to stay, right? I mean, it's not going away. It's going to get worse before it gets better, until the Biden administration figures out how to stop handing out money and starting new programs, and we start spending money we don't have, right? Inflation is not going to get better. It's going to get worse. You pay the price. Whenever you spend money, somebody has to pay for that. And the way it's going to be paid is by issuing more bonds, more treasury bonds. Basically, inflation will cause interest rates to go up, right? And I think that's something that we're going to live with for a long time, and I don't think they're coming down anytime soon. So let's talk about these recent bank failures. Silicon Valley Bank. In terms of scale, it's the 16th largest bank failure of all time. Signature Bank is the 19th largest bank failure of all time, and First Republic is the second largest bank failure of all time. So these happened in a very short period of time, and they're all incredibly significant events. So what caused these banks to failure? Why did they crater? Okay, so I'm going to argue that there are three things that can cause a bank to fail, right? And it's the stability of your depositor base. Okay, so what happened at Silicon Valley Bank? It was basically the bank of venture-backed VCs, tech, life science VCs. So think of bio-type, pharma-type companies out on the West Coast. And so they had an incredible amount of lending to these, and in exchange for providing these loans, they encouraged those companies to deposit money. The entrepreneurs deposited their own money and maintained balances at the bank, right? So 93% of all the deposits at Silicon Valley Bank exceeded the FDIC guaranteed limit. So for the high school students, if you have a savings account or you have a checking account at a bank, the federal government will guarantee that no matter what happens to that bank, if you have less than $250,000 in your bank, which I assume all of you have less than $250,000 in your bank, that if the bank fails, the government will pay you back and you won't experience a loss, right? Well, at Silicon Valley Bank, 93% of all their deposits were above that limit, and they weren't insured. You get $250,000 back, but anything above that is not guaranteed. Now, if you are one of those depositors and you think something might be happening at your bank, what is the rational thing for you to do? Get your money out of there before it collapses, right? That's called a bank run. When the depositors lose confidence in the bank's ability to guarantee their deposits, they leave and find a safer spot for their money. So in this case, this is an issue because to the extent that you have your depositors under that $250,000 limit, then you're much less likely to leave because your money's safe regardless of what happens. So one of the things that is important in a bank is to look at what fraction of those deposits they have that are less than $250,000, right? It's kind of a measure of how likely your depositor base is to run if something bad happens. Oh boy. The second thing we're going to talk about is interest rate risk. Now, banks do a lot of things with your money. All right? And in this case, one of the places where banks put their cash is in U.S. Treasury securities. Okay? So on a bank's balance sheet, they have a lot of assets. Some of those will just be investments that they've made with the deposit. So imagine you're a depositor, the money's coming in to the bank has this cash, but before they make a loan to somebody, they have to do something with the money. So they invest it in Treasury securities. And the reason they invest in Treasury securities is because there's an entire regulatory regime that supervises banks. And they have to maintain certain capital levels, and they get credit for, and the capital that they have to post is a function of the assets that they hold. And so if you hold Treasury securities, they're viewed as riskless from a bank regulator because there's no, we don't think that U.S. Treasury securities are ever going to default. Okay? So the regulators give you full credit for that. So banks put their money into Treasury securities because it helps them with their capital requirements, and they don't have to keep as much regulatory capital. So what happens is some of these banks decided that when they had treasuries, they wanted to earn a little bit extra money. And typically the way you earn a little bit of extra money in the treasury market is you buy longer term treasury securities. It just, for whatever reason, the interest rate that you historically earn on longer term securities, treasuries, is higher than what you earn on short-term Treasury securities. Now, the difference is incredibly small, but that didn't deter some of these banks from chasing that little bit of extra yield. And so what happened was those longer-term bonds are incredibly sensitive to changes in the interest rate. And so when interest rates started to go up, these bonds went down in value. A short-term bond doesn't go down in value very much. A long-term bond goes down in value a lot, maybe 13 to 14% overnight, if the rate goes up a couple percentage points. So all of a sudden, these banks who thought they were holding this high-quality, riskless security found that interest rates going up the way they have recently, they had significant losses on their investments in these Treasury securities and put them underwater. And this is really what caused a lot of these depositors to become concerned, because now all of a sudden it doesn't look like the bank is solvent anymore, because the losses on some of these Treasury securities were so large that they were actually underwater, right? And so the depositors, recognizing this, and decided maybe it was time to leave. All right, and then the last thing I want to talk a little bit about is liquidity risk. This one. And so one of the things that we worry about with a bank when something like this happens and depositors begin to run from your bank, do you actually have the cash to pay them so that they can leave the bank? And so another problem that happened at Silicon Valley Bank is they didn't really have much in the way of cash, right? And so the depositors who wanted to leave quickly overwhelmed Silicon Valley Bank's ability to let those depositors take their money out of the bank, which is why the bank stopped. So companies, banks that hold significant amounts of cash, significant levels of short-term Treasury securities, are in much better position to withstand depositor withdrawals. So that's what happened at Silicon Valley Bank. Maybe not, Casey. All right, so what happened at Signature Bank? Pretty similar story. I mean, these things, the same macro events that affected Silicon Valley Bank affected everybody. So what was Signature Bank? They had sort of a different business model than most banks. What they did was they courted high net worth individuals. They actively sought out people that had a lot of money. And they provided what they considered to be kind of a high touch business, right? And so their clients they did a lot of law, they had a lot of law offices, they had a lot of real estate buyers. They also catered to crypto companies. I think Coinbase had most of its cash deposited in Signature Bank. But so 25% of all of its deposits were from crypto firms. And when crypto collapsed initially, that was a big event for them, and those firms needed money, so they withdrew money for their own business reasons. But at Signature Bank, 90% of all their deposits exceeded that federal guaranteed limit of $250,000. So Signature Bank, all the depositors in Signature Bank watched what happened at Silicon Valley Bank. They saw everybody leaving. That created almost a panic type situation, and this is what the prudential regulators worry the most about, is that people will see what happens in one bank and that it will now affect their bank. And so depositors start to run, even though maybe Signature Bank was in better shape, but the fact that they had 90% of their deposits, that meant these were the customers who were the most at risk and the most to lose, and so they started to withdraw assets as well. They had relatively low liquidity, so there's a lot of this liquidity risk. They did not have very much, the Signature Bank didn't have much cash. All right. So what happened at First Republic? Actually, they didn't look nearly as bad as either of these other banks, right? They still had a significant amount of their deposits that were above this minimum, 68% of their deposits, but they made a lot of loans from their deposits. So 92% of all their loans were derived from deposits. And that's what a bank does, right? The bank takes your money, and then it uses that money to make a loan to somebody else. And the difference between what the bank pays you and what they charge somebody who's borrowing, that's how they make their money. Well, they had a disproportionately high amount of loans relative to deposits, which meant that they were sort of exposed to this same type of run-like behavior. All right. They had one of the features of this of First Republic that made them different was that they offered very low mortgage rate loans to their preferred customers. Mark Zuckerberg had a really nice loan from First Republic Bank, right? And so they offered really low interest rate loans, but they also paid relatively low rates of interest on their deposit balances. And because they had a lot of wealthy individuals, as soon as the interest rates started to go up, if you're not making very much on your deposit, and there's an opportunity to make significantly more by putting your money in somewhere else, they found depositors running because they had better opportunities at other banks. So they just left First Republic in search of higher yield. It could be as easy as buying a treasury bond or a treasury bill. So this caused, I think, a lot of the instability at First Republic. All right. So I'm going to talk a little bit about why we got ourselves in this situation in the first place. And much of this is, I think, the result of the actual prudential regulation that takes place in the banking sector by the Fed and the FDIC. Right? So there are a lot of different, so what I mean by prudential regulation is I worked at the U.S. Securities and Exchange Commission. We're called a disclosure-based regulator. And when I mean a disclosure-based regulator, the SEC is interested in providing investors with the information they need to make investment choices. So as a public company, if you are traded on an exchange, you're going to be filing annual reports, a 10K. You're going to be filing quarterly reports, 10Q. You have all kinds of disclosure requirements if there's significant events, like an 8K, right, which is any material event, you actually have to tell your investors that that took place, right? So that's a disclosure-based regulation. The Fed and the FDIC have what's called a prudential regulatory policy, and that means they actually go into the bank itself and they track and monitor what's going on in the banks in real time, right? So the SEC, a disclosure regulator, doesn't track its companies in real time. A prudential regulator does. And so they set policies, and they tell the banks that you have to do things. All these banks that failed, they were deemed to have adequate levels of capital. So according to the prudential regulators, they shouldn't have failed because the amount of capital they were supposed to post was designed to prevent failures. Capital in a bank is a little bit of a buffer between the loans and the deposits, right? And what the capital does, that's the equity in a bank. That slice is there to buffer against runs. So if there are runs and losses with runs, the equity holders are the ones that basically realize or incur those losses. So the banks were compliant with all the capital requirements, but after the financial crisis of 2008, when all these large banks failed, right? We had sort of the meltdown in the banking sector, right? When Lehman Brothers failed, Bear Stearns had problems, right? So the big problem there was something related to default, right? That these banks, they became over concerned about asset defaults, not liability defaults. So what happened at these banks is that the assets they were holding became worthless, and it caused these banks to go down. So the regulator said, well, let's make sure that we kind of shore up the asset side. So all of these regulations that Dodd-Frank passed was just designed to force the banks to hold what they deemed to be safer assets, like treasuries. So the banks had to hold a lot of treasury securities, but they didn't worry about interest rate risk because coming out of this environment, interest rates were close to zero, right? So there wasn't and the Fed was basically telling all of us that they were going to stay low for a long time. That's really what encouraged these banks to chase yield, because they felt if interest rates are going to stay low for the next 10 years, I might as well go out and buy some long-term treasury bonds. And it was this overemphasis on asset risk and the ignoring of interest rate risk that got everybody in trouble. And the way the prudential regulators track this is they force banks to do something called a stress test. And the stress test that they do is it's basically an exercise where you say, if a certain event happens, how much are we going to lose? And they had all kinds of bad things happening. The one thing they didn't bother to be worried about was a change in the interest rate. Interest rates were close to zero. They figure it's not going to go lower than that. How much? I have 20. Oh, I'm talking way too much. All right. So basically what happened was that they didn't worry about higher rates. Why don't you worry about higher rates? Because in your mind, they're not going to go up. So they actually didn't put it into the stress test. If that had been part of the stress test scenario, you would have been forced to hold a lot more capital if you held these long-term treasury bonds. They didn't. I think it was more of a political choice not to acknowledge that interest rates could go up than it was an economic choice. And so you have politics creeping into the prudential regulatory regime, and as a result, I think this is why they bailed out Silicon Valley Bank. They did it to prevent other bank runs, but the reason they went in and I don't know if you know this, but at Silicon Valley Bank, not only were the accounts under $250,000 going to be insured, the FDIC and the Fed came out and said, we'll insure everybody. No one's going to lose. In my view, that's bad policy. If you take a risk, you should be forced to realize the downside that can be associated with that risk. I would not have bailed those banks out. I would have let Silicon Valley Bank go down without the guarantees. Okay, now let's take a look at where Merchants and Marines Bank sits. All right. So I selected a set of banks that I thought were comparable. How many of you heard of ChatGPT? All right, so what I did was I went in and I said, ChatGPT, I said, I want you to identify a set of comparable companies for Merchants and Marine Bank. And ChatGPT gave me a list of banks back. And I used those banks in my analysis. And then when I made this presentation last year, I had a different set of comparable banks. So I wove in some of those additional comparable banks. And here they are. Bank of South Carolina, Bank First, Cambridge Bank Corp., Community Bank of Mississippi. A lot of these are very similar. They have similar profiles to Merchants and Marine Bank. But I did put in some relatively large banks like Renaissance Bank, just to give you a feel for what a big bank looks like compared to a community type bank. Right? All right, so those are the banks, and I came up with some metrics. So the first thing I thought, I did this last year too, and one of the things that always strikes me about your company is how, in my view, dramatically undervalued it is in the market. Right? This is, in my mind, is a buying opportunity. It continues to be a buying opportunity. What I did was I put the price to book ratio. So this is the market price of a share of stock divided by how much book equity you have. Right? And in the case of Merchants and Marines Bank, you're paying less than $1 for book value. Right? This is a huge deal. And so so what I've done, I just simply ranked all the banks in my comparable set. This is as of 12/31. And what you can see is this is before the crisis really kind of broke out, and they are well below everybody else. And many of these banks are trading at premiums to their book value, which is what you would normally expect a company that's doing reasonably well to do. If you have a solid company, you expect the price to be at least worth the book assets of the company. The fact that it's less tells me it's undervalued. So I did the same thing as of May 1st, and on May 1st, Merchants and Marine Bank actually went up. I actually think if you did it today, it would be back down, but unfortunately, but it's still one of the most undervalued banks. You can see that some of these banks, which act like Renaissance Bank, Renaissance Bank looked pretty good. It was basically $1 for $1 prior to when when all these troubles at Silicon Valley Bank. Now you can see that investors have basically caused Renaissance Bank to become much lower priced. So these banks that now fall, that have now doing worse than, let's say, Merchants and Marine, they're there because they aren't doing so well, and investors are recognizing those banks are problematic. All right, so now let's look at, the way you should look at these slides is whenever you see a green bar, that's where Merchants and Marines Bank is. And so these are capital ratios. So this is how much equity capital you have. Equity capital is that amount that you hold to buffer against problems. So across all the banks, Merchants and Marine Bank has the second highest level of capital. Interesting, Renaissance Bank has the highest level of capital. This was measured on these, because most of these, I extracted this information from what's called a call report. And call reports are required disclosures that banks have to make to the FDIC. All right? And so many of these companies haven't released their first quarter in 2023 call reports. So to get my comparables, I had to use the 12/31. So think of this as, this is what it looked like before everything went crazy in the banking sector. Right? And so before anything happened, Merchants and Marine had the second best capital ratio relative to all the other banks, which to me indicates it's pretty stable. Now, this slide thinks about the situation at Silicon Valley Bank, and this measures the ratio of insured deposits to uninsured deposits. And you want a higher ratio, because the higher that ratio is, the less likely the depositors are to leave the money. That means I have 15 minutes. Actually, it means I should probably shut up by now. But I'll go through this real quick. Yeah. And so your bank has a ratio of 59%. So 59% is the ratio of insured, uninsured deposits. And what you can see is out here, these are the banks that have significantly more uninsured deposits. So the way you look at this bank, you want to be as close as you can to the spot, and you're basically in 5th place there. So you're not on top of everything. Here's one where it's the ratio of loans to deposits. So the more loans you have, you basically want to have a low loan to deposit ratio, and so Merchants and Marine Bank looks like they're about 4th place there. All right. This is the ratio of the amount of cash Merchants Marine Bank has to deposits. This is what you would use to pay anybody that wants to take their money out of the bank. And you have the highest ratio. You have 12.4% of your balance sheet is in cash right now, and that can be used to pay any depositor that wants to leave. And you can see that some of these banks have incredibly small ratios when you get out here. But Merchants Marine Bank really stands out relative to everybody else. Here I have, let me go back there. All right. So this is a measure that I put together that says, if depositors were to leave and you had to sell your investment portfolio, the assets that are the easiest to sell right now are ones that have fairly short maturities, right? Because they don't have nearly as much loss. It's a much more active market. And so I took the ratio of these short-term investments to deposits, and what you can see is that Merchant Marine Bank has 16.8. I got the green bar wrong there, but so about 17% of all your deposits are backed by short-term securities. So combine that with the really significant amount of cash that's on the balance sheet, and you can see there you're able to withstand a lot of stress on your deposit base. This is my measure of how much exposure you have to interest rate risk. So this is the ratio of investments that of your treasuries that have a maturity of more than 5 years to total investments. And what you can see is that Merchants Marine Bank hasn't been afraid to dip its toe into longer-term maturities. 51% of all of its investments are in longer-term securities. But compare it out here to Southern Bank Corp or FFD and Renaissance Bank, and you can see that there are some firms that have significantly more. So Merchants Marine Bank is exposed to some of these fluctuations that are taking place in the interest rates. But given how much cash they have on their balance sheet and how much short-term, it's not really an issue. And so what I did is I took all these together. This is kind of a heat map. This just shows all these different factors and where Merchant Marine Bank put itself. So these are the various rankings. And I did this for every single bank. And what I did was I just took the average ranking across all these different factors, right? Each of these factors, and I just said, what's the average? And Merchants Marine Bank came out on top. When you looked at all these different rankings, its average rank was the best across all these various metrics I put together to describe what might cause a problem at a bank. And so we did that, and then I'll close with just a quick discussion about Renaissance Bank, or PacWest. So where does PacWest sit into this analysis? It would be, if you looked at some of these ratios, I basically pulled its call report this morning, and the ratio of insured to uninsured deposit at PacWest is 42%. That put it pretty far out on the tail. It was out of the 16 banks, add in Merchants Marine Bank. So now we're ranking 18 banks. It was in 12th place. Right? So not good. What's the ratio of cash to securities to deposits, it's 14%. That put it in 11th. What is the ratio of loans to deposits? Put it in 12th place. What's the ratio of how much interest rate was it exposed to? So the ratio of long-term securities, it's in basically last place. And if you look at how much treasury securities it holds relative to deposit, it has one of the weakest ratios of that as well. It's in 16th place. So if you put all those ratios together, it looks like a bank that would not be ranked very highly by this scale, right? So clearly well below median, right? And so that could explain why it's lost about 40% of its value overnight. Right. So that's what I have. I think we wanted to hold a little bit of time for Q&A, so we'll just maybe pivot to that.
Craig, if you want to take a seat, we'll do
Okay.
Q&A. I think if we can put the number to text on the board. And we'll format this the same way we have in past years, where we'll have the ability to text in, and that number should be on the board in just a second. And in the meantime, we can also take questions from the audience if y'all have any. Thank you for the analysis on the banks. I'm glad that we fell where we did. It was something that we've looked at for quite a while, and I will point out that we have gone out on the securities curve a little bit in the last couple of months, but it has been in the last 6 months or so that we've done that when interest rates have kind of gotten to where they are. So hopefully we were at the top of the curve when we took that.
With your analysis, do you have any predictions of what other banks might fail in the near future?
Do I have any vision for which banks might fail? If I don't have my clicker anymore, but if you would go back to that last slide, I would say that the ones that are at the bottom of that chart are the ones that are the most likely to have problems. So according to my analysis, the one that is in the most trouble right now is Cambridge Bank Corp, followed by Home Loan Savings Bank and FFD Financial, which I believe is a private bank, and then Lions. Those are the ones, according to my analysis, that if you were to accept my analysis, those would be the ones that would be at greatest risk. Be interesting to see how some of those share prices did over the last couple of days.
And we had an interesting conversation actually last night with a couple of the bank's investment bankers, and it revolved around chicken or the egg kind of mentality. Could stock price falls cause a run on deposits because the depositors are scared, or are depositors causing stock price falls? And it seems like both.
It's both. They're both endogenous, right? When you see the stock price dropping, that's a signal to people that weren't paying attention that maybe they should have been paying more attention.
And we saw a good bit over that last night. I think there are 5 or 6 regional banks that have more than 30% fall in their share price in after-hours trading. So that was kind of concerning to see.
Any of them up here?
You got a question up here. You mentioned inflation, and obviously the Federal Reserve increased short-term interest rates again yesterday. We're from the mortgage side, and our economists with the Mortgage Bankers Association have been predicting interest rates to drop again. And really, they were anticipating interest rates to drop in June and July. Based on what you're saying, that doesn't seem that's going to be possible. Your thoughts?
My thoughts are I would find it, I don't think interest rates are going to drop. I think that the government is continuing, right, to have programs that need to be funded, and I don't see how we're going to stop inflation until we kind of get past that. And if you really think about it, where they are today, it's not that far off historical interest rate levels. So, when I first graduated from the Ohio State University, I got a loan on my first house at 11.25%, right? And that was my mortgage rate, right? And I was investing my money in a money market fund and earning 18% on treasury bonds, right, basically. So when you see the interest rate environment we're in today and we think it's near zero, I don't understand how it ever got below zero, close to zero, but I think we're at what I would view as kind of a long-run historical rate that may even be, even today, is a little bit below historical rates that we've had in this country. I mean, when I was a kid, you got 5.25% in a passbook savings account, right? And the mortgage rates are above that. So to me, those rates in the 6 to 7% range seem more like the historical long-run average. I don't think we're doing anything to dial back inflation. I mean, I don't think government spending is going away. So I think we're kind of there for a while is my prediction.
Another question back here.
Good morning. Thank you for the presentation. So you explained the effects of banks investing in long-term treasuries when rates are low and the effects of interest rate changes when those rates go up. Can you, for the audience, discuss if a bank, let's just say timing is right and they invest perfectly at the height of that bell curve and things do start to come back down, the effects of a bank investing in long-term treasuries at the right time?
So the question is, let's flip it on its head, right? And the point I was making is when you're looking at a rate that's close to zero, there's only one way they can go, and that's up. So there's virtually no upside on an investment in a treasury, but there's a lot of downside, and that's what banks are facing. Now, if you are thinking about investing in a treasury after rates have already gone up, now you're trying to lock in at a higher rate, right? So let's say it's 2.5%, right? What can happen is if rates go up again, they're going to go back down. You're going to lose money. But because the rate is above zero, if rates were to go down, as you're predicting, then all those investments you've made in treasuries are going to appreciate and they're going to go up in value. So when rates are at a non-zero level, you can win and lose. When rates are at a zero level, you can pretty much only lose, right, in terms of capital appreciation. So if you time it perfectly, as the questioner said, then what timing it perfectly means is that you think you've hit the high. And now you're thinking, I only see good stuff. I don't really ascribe to that view, but to answer your question, you would basically make money if you did time it right.
We did have a question come in from the great beyond. Do you think the Fed has the tools necessary to battle inflation and win?
They're in much better position today than they were a year ago, because when the interest rates were zero, they lost their primary mechanism for battling inflation, right? And they had to try to do other things, right, like quantitative easing programs. When the interest rate is non-zero, you have more tools in your toolbox to battle inflation. So at the margin, yeah, they have more tools. Yeah.
Appreciate the presentation, really good. I have a question about the Treasury market and inflation. They tend to disagree with what you're saying about with the yield curve the way it is. Why is that, and where do you think that's headed?
It's because so the question is the inflation rate and the yield curve, are they out of line? And they are, right? I mean, when I teach my class on company valuation, one of the things it's a valuation class. One of the things we talk about is what causes revenues to go up at a company, right? And inflation is one of the key things that causes prices to go up and sales to go up. And so I've historically told my students that the quick and dirty way to get a good forecast of inflation is to look at the Treasury market and subtract off about 50 basis points and call that your inflation rate. And the reason I've historically said that is because the Treasury rate perfectly correlates with the inflation rate. But what has happened with the Fed's desire to try and keep interest rates low is they've artificially caused there to be a disconnect, right, between the historical inflation rate and what the Treasury rates are. And so I don't think it's an accurate measure. And over time, they have to converge at some point. They're not there, though.
We've got time for probably 2 more questions, and we do have one, again, coming in from our viewers online. What's keeping you up at night economically?
What keeps me up at night economically is I'm retiring and I'm trying to decide if I'm going to have enough money to, how much assets will I have going into retirement. So the things that keep me up, the ones that bother me the most is I'm worried a little bit about what would be the fallout if the debt ceiling doesn't sort of resolve itself, right? Because my own personal portfolio, I have a lot of treasuries I'm holding. And so I'm trying to think what's going to happen to treasuries if, they can't get the debt ceiling issue resolved. I think there's close to a zero probability that it doesn't get resolved, but I do think that's one thing I worry about. I have some crypto, so I'm kind of watch what's going on in the crypto. I don't have a lot, but those are the two kind of asset classes that are causing me the most concern right now.
And that's a wonderful lead into our next question as well. It comes from one of our students. In your opinion, as an 18-year-old, what would be the best way to invest my money for the future?
I think that's a clear answer because you have a long time. I would invest it in the stock market. I absolutely would just go out and put my money into a mutual fund, or really what I would buy if I were you is I'd just go out and buy an ETF, like the S&P 500 ETF, a SPY. I would literally say, put my money in that. You're going to lose money, you're going to make money, but you will earn a lot more by having your money invested in the market over time than you will if you put it into the bank. All right, so that would be my advice. But maybe you're worried about saving for college and you actually can't afford to take the risk associated with stock prices coming down. If you need money to fund your education, then you should probably protect the money, and putting it into a bank or something like that is probably a much better investment for you in the short term. But long term, I think to me, it's clear you want to be in the market.
Thank you. I think that does it for our time with questions today. Dr. Lewis?
Thanks.
Thank you again.
Thanks, Casey.
Okay, folks, it's time to start the meeting. I want to welcome each and every one of you here today, and also those who are attending via live stream. We're in for a treat this morning. We have our Pascagoula High School Choir, led by Dr. Sherry Bowie. Okay. And they'll be singing the national anthem and also doing our Pledge of Allegiance as well. So thank you for being here this morning.
Oh, say, can you see by the dawn's early light what so proudly we held at the twilight's last gleaming, whose broad stripes and bright stars through the perilous fight o'er the ramparts we watched were so gallantly streaming, and the rockets' red glare, the bombs bursting in air, gave proof through the night that our flag was still there. Oh, say does that star-spangled banner yet wave o'er the land of the free and the home of the brave?
Our flag is this way. Attention, salute, pledge. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. You may be seated.
Thank you. Patriotism is still very much alive in the South. And I think in some studies we did years ago, the South, people in the South are the most patriotic folks in the entire land, and it's good to see. Okay, I'd like to open up the shareholders meeting, and at this point in time, we need to ask that Mac Rushing and Stacy Enlow, if you would, to serve as our tellers of election. And I'd like to ask you to go back and see if all the proxies are tabulated. We need to be sure that we have enough proxies voted so that we can hold the meeting. We have to have 50% plus one. So, and I think we're there, but we'll get an official account when they get back. So, we will take just a short pause here. Okay, folks, I think we've decided that we can go ahead and receive Clayton's presidential comments while they're tabulating that. Maybe sometimes good time to break in here. Clayton Legier.
Right. Good morning. Royce, thank you for the introduction. Ladies and gentlemen, it's great to be with you today. I have to forewarn you that you're probably going to hear some repeated themes from Dr. Craig Lewis's comments earlier. He did a wonderful job. We did not compare notes on our presentations, although there will probably be some similarity. But before I get into that, I want to take a few minutes to thank Dr. Bowe and the wonderful choir we just heard. I also want to thank all the students we have in attendance. You'd be pleased to know we have students from a variety of local high schools, from Moss Point, from Goche, from Pascagoula High School, and from Resurrection Catholic School. And guys, we're so thankful to have each of you here with us. My challenge for you is going to be to consider banking as a career whenever you get out of high school, when you get out of college. Bankers need talent like you to come in and help us refill the ranks. And I hope you'll consider that as you think about your future path. But it is so exciting to be able to stand here with you today and to give you an update on the performance of your company over the last year, to share some pretty exciting updates, frankly, updates that I've been waiting to share for about 2 years, as our company has undertaken a very strategic retooling of our balance sheet, of our revenue mix, and of the way we operate as a company to drive long-term value for our shareholders and greater stability for the communities we serve. With that being said, we'll go ahead and jump in. And before I give you the context of 2022's financial performance, I want to go ahead and paint a picture for you on the factors that are impacting us now and the factors that impacted us through 2022 as we operated. Again, some of these are going to be very similar in nature to what you heard from Dr. Lewis in his presentation. But first and foremost, I want to hit the obvious. We're in an inflationary environment. I don't know if you're aware of that. I hope that's not news to you, but inflation is here, and unfortunately, it is not transitory, as the Fed initially thought. So I have a graph that I'm going to refer back to for what's probably going to seem to be long comments. And I realize my attention span is really short. You can ask my wife, bless her heart. But if you have limited attention span, I would encourage you to pay attention for this slide, because this will set the tone for the remainder of the comments. And this slide, as it's put out, is really going to guide the crafting and the thesis that we have operated the company under for the last several years. So, as Dr. Lewis pointed out, we had a small thing happen in 2020 called COVID. And whenever COVID hit, our government responded in very, very significant ways. And so I have 3 lines on this chart. The green line, think of it as representing money. That is the total percentage change in deposits held in United States banks over the prior year. So at any point when you're viewing that line, think about that is the change that happened at that moment when compared to the prior year. The red line, think of that as the fires of inflation. That is inflation as measured by the CPI. Now, there are multiple inflationary measures. I'm thankfully not an economist, so I don't have to know all the nuances of those. But CPI for all urban consumers is generally agreed upon as being a fair assessment of where inflation is. And the blue line at the bottom, that is the Fed funds target rate. So the overlap of these 3 graphs is going to be a concept that we're going to come back to over and over again as we talk about the performance in 2022. So the gray line in the graph in 2020 is the flash recession that was caused by COVID. And you see two things happen immediately thereafter. One, you see the green line skyrocket. And if you'll remember, we were in a stimulative environment. The government stimulated everybody. We had Paycheck Protection Program loans, employee retention tax credits. We had child care tax credits. We had enhanced unemployment benefits. We put so much money into the financial system, and that money ended up in individual bank accounts throughout the country. So that drove up deposits system-wide for all banks. At the same time that was happening, the Federal Reserve, in an attempt to make sure that the economy did not collapse, pulled all friction away from the economy by reducing the Fed funds target rate down to nothing, 0 to 25 basis points. And so the divergence of those two lines meant that banks were saddled with tremendous loads of deposits, lots of cash, trying to figure out what to do with that cash at exactly the wrong time, because there were no really good options available. As Dr. Lewis said, rates were incredibly low. A 10-year U.S. Treasury bond in this period was yielding 0.75%. And so banks found themselves in this position of having a lot of cash and nothing to do with it. And unfortunately for many of our brethren, many of our peers, they found themselves with a toxic combination of shareholder pressure, activist shareholder pressure, analyst pressure, pressure from their boards to make really short-sighted decisions. We've got to do something with this money. We've got to drive a return. And so they committed the mortal sin in banking. They mismatched the durations of their deposits and their assets. They mismatched, and that is the crux of what's causing most of this banking crisis. Suffice it to say, as you see in the graph, the red line responded pretty strongly after 2020. The Fed thought that maybe inflation was transitory. They didn't want to raise rates too soon because little to no inflation is bad, right? And the Fed judges that their long-term goal is to keep inflation around 2%. That's where they think the stasis level of inflation is safe. They think that's appropriate. And so as it really began shooting up in 2021, they were caught in the crosshairs of figuring out, do we begin raising rates now, or do we wait and see if this is just a flash in the pan? And of course, as we know now, it was anything but flash in the pan. And so Dr. Lewis did a great job of talking about banking sector turmoil. I have another slide I'm about to blow past because I want to use this as the talking point for that slide. Suffice it to say that the banking system as a whole is experiencing significant turmoil right now. Our company is very fortunate in that we are not, and that is not by accident. That is due to the deliberate construction of a balance sheet that is battle ready. We were afraid this would happen, and so at the same time that all of our brethren were taking those temporary inflows of deposits when the green went up and they went buying crazy, right, buying bonds and replenishing their investment portfolio, we judged it to be appropriate to sit on the sidelines and hold back that cash so as to avoid getting trapped when rates did go up. And as you'll see the blue line begin ratcheting up in 2022, it's important to note that as of yesterday, the Federal Reserve has raised interest rates 10 times in the last 12 months. The last time that happened was 40 years ago. So it's been 40 years since interest rates have been raised this far, this fast. This is a once-in-a-generational workforce sort of endeavor that we're dealing with. And what is causing the banking turmoil that has led to banks like Silicon Valley Bank failing, First Republic failing, Credit Suisse failing, Signature Bank New York failing, and right now, as we're sitting in this room, there are conversations going on in the community about banks, Pacific West Bank or Western Alliance Bank. If you look at their stocks, they're being halted, right? There's contagion spreading through the banking sector, and it's all rooted in the fact that deposits are going down. If you look at the green line on the far right side, you see that we're exiting a period where deposits are no longer growing. People are pulling their money out of banks, and it's not just out of one bank or two banks, it's out of all banks nationwide. And it proves out that the deposits that landed on our balance sheets post-COVID were indeed surge deposits. They're not permanent deposits, they're not lasting deposits, they're not organic deposits, they were surge deposits. And as these deposits are flowing out, those bonds that were purchased by banks at really low interest rates are now undervalued. And the only way that they can liquidate those bonds to pay depositors to leave is at significant losses. And to put this in perspective, there are approximately 100 banks across this country that have less than a 2% capital ratio because of this very fact. There are some banks operating today that have negative capital. And it's solely because of the fact that whenever their balance sheets swole with deposits and rates were at all-time lows, they succumbed to the pressure and forsook that long-standing banking rule of never reaching for yield and never mismatching your deposits that you've been entrusted with the assets that you invest those in. So suffice it to say, I think we're far from done with the banking crisis. I wish I could get up here and paint a rosy picture for you and say that everything's going to be fine. I don't think it is. Our company doesn't think it is. But it's important for you as a shareholder to know that we've built our balance sheet deliberately over the last 3 years to be prepared for this moment, not just to survive this chaos, but to thrive in this chaos. That's been a key focus for us. I know last year we talked a little bit about cryptocurrency and blockchain. I know for our students that are in the audience, this is kind of an interesting world. I find it very interesting as well. Unfortunately, for those in the cryptocurrency sector, they would say that they're in the crypto winter, right? So we saw over a 2-year period the loss of 60% of the value of all crypto assets. To put that in perspective, cryptocurrencies all aggregated together equaled around $3 trillion at the end of 2021. Today, all cryptocurrencies rolled together equal about $1.2 trillion. That's a major loss in value. And that value came from loss of confidence in the platforms, that came from loss in the people who are running the platforms. A gentleman named Sam Bankman-Fried, who we've all heard about, the founder and CEO of FTX, which took in tons and tons of individual deposits with this very holistic view that we're going to change the world and we're going to decentralize finance and we're going to get it out from under the banks and we're going to get it out from under the governments and we're going to empower the people to transact with each other. And if you need money, you borrow it from your friends through these platforms. And unfortunately, the unraveling of FTX and the fraud that was uncovered really shook the confidence in this whole sector. And it led to a massive, massive running away of deposits and valuations in this sector. The other interesting thing, and I think it's a fallacy in the fundamental ethos of the crypto industry, they operate with the naive belief that we can operate without government regulation, right? They think that's possible. Unfortunately, the government can regulate whoever, whenever, however they want. They have that authority. And what you're seeing now is entities getting involved in regulating crypto. We've actually seen the first insider trading charges brought in the space recently by some of our regulatory friends against someone who operated a non-fungible token group. And so they had insider trading on those tokens before they were selling those. And again, this is an industry that prided itself on operating outside of the fringe. The government, Big Brother, will never supervise us. And what is happening now is that the government's proving they can and they will supervise and regulate cryptocurrency, non-fungible tokens, the metaverse, and everything else that's built on that blockchain infrastructure. And I would argue that's for the better good of society as a whole. When individuals can sit there and lose $2 trillion, or when individuals can be lied to and manipulated by people like the founders and executives of FTX, that's not good for us as a society. So there needs to be some regulation. But as that regulation comes, we would expect the consolidated value of the cryptocurrency, the metaverse, the NFT space to continue to stay well below those values that saw in 2021. Last but certainly not least, we are in a regulated industry, a tightly regulated industry, and it's always interesting to see what our regulatory friends consider to be those red flag issues, right? You know, they're charged, as Dr. Lewis said, with prudential regulation. Folks like the FDIC, the state bank departments, the Office of the Comptroller of the Currency, their key job is making sure that banks don't fail and making sure that banks don't harm consumers, right? Kind of their dual mandate. Keep them alive and make sure they don't hurt individuals in the process. Unfortunately, most recently, they probably have missed some risk that's been materializing in the system. I think it's fair to say. Instead of focusing on the growing bubble in terms of mismatch between asset and liability durations, regulators have continued to remain focused on the consumer side of the house. Now, there certainly is work that's needed there. I think it should be a focus, but instead of focusing on the growing insolvency of banks around the country, regulators have remained focused on things like new small business reporting, which would require banks like Merchants and Marine Bank to disclose details of all loans made to small businesses publicly. Right? This is done. This law is in place. There's an effort to get it repealed, but if you come to us as a small business owner to borrow money, we're now going to have to begin capturing data about your transaction and making that available publicly. Pros and cons, as with anything, but that has been the focus. The focus has also been a war on what regulators consider to be junk fees. In general terms, they think it's wrong for banks to assess fees of any type. It's wrong for us to assess statement fees. It's wrong for us to assess fees for overdrawn accounts. And there's been a war on those types of fees, which has reduced overall industry net income. And this has all been going on while this risk has been building in the system from the mismatch in assets and liabilities. So suffice it to say, the regulators are finally aware of the risk presented by the unrealized losses in bank bond portfolios nationwide, and they're keyed in on that. I will say one of our key concerns is that regulatory matters tend to be cyclical. And so our biggest concern is that there's going to be an overreach on the other side. And the banks that have taken the prudent road, banks that have focused on building a balance sheet the right way, banks who didn't answer the siren's call of chasing yield and getting an extra 20 basis points while putting your entire franchise at risk, are going to be saddled with additional regulation that really should be targeted at those banks who did make poor decisions. That always seems to be the case in regulation. But that is the backdrop that we have operated in 22 and that we continue to operate in. And so I thought it would be appropriate to hit that before we really get into the financial results. And so first up, I want to let you know that our balance sheet trends, I don't know if you've ever read the quote about a duck, right? Like the duck, the woodland creature that flies and swims, and it's often said individuals who exhibit great poise and grace. I think of someone like Jackie Skelton. I've told her this before. She always seems so calm and collected. And if you look at a duck on the surface, they seem so calm, so poised. They're just gliding effortlessly across the water. But you know that under the surface, to enable that sort of progress on top of the water, they're paddling like heck, right? There's a lot of work going on. That's the best analogy I can tell you about our balance sheet. If you're looking at overall total assets, you're going to say, man, there's really not a lot of change there. They're about the same size, not really a lot of growth. Growth is good. When in fact, there's been a lot of change in reconstitution of our balance sheet. And we're going to talk about that in greater detail in just a moment. But in terms of points that I would make here, one, we have had a very significant amount of loan growth. If you're looking at loans, loans are the red line there. So you will see that our loan portfolio is now more than $400 million in gross loans. That's as of 3/31. You should know in 2022, the bank grew loans by more than it ever has at a clip of 15%. So loan portfolio grew 15% in 2022, just as rates were going up, which is a material improvement for all of our margins. It's a material improvement to our profitability. We were able to do that in a rising rate environment. So if you're looking at total loan growth over the last several years, you would see that loans have grown by more than 30%. And I would argue that the credit risk metrics that we have, and I'll show you those, are stronger today than they've ever been for our company. In terms of metrics like past due loans, problem loans, they're stronger today than they've ever been. At the same time, we have radically reconstituted our deposit base. Going back to the graph, we've got the green line, the red line, and the blue line. Whenever our balance sheet swole, and we disclosed this to y'all a couple of years ago, we used that opportunity with those excess funds to allow us to rebuild our deposit portfolio, to prioritize stable, low-cost deposits. That was our focus. We love our CD customers, we do, but we're not in a position to pay the highest rates on CDs. So we use the excess money, instead of buying long-term assets, we use that to allow us to fundamentally alter the profitability of the company for the better, for the long haul, to stabilize our deposit base and to reconstitute that. And so again, the analogy of the duck really comes to mind. From the surface level, looking at charts like this, it looks like nothing's happening. But when you factor in the significant, strong organic loan growth, when you factor in the very disciplined retooling of the deposit base of the company, we are fundamentally in a stronger position today than arguably we've ever been as a company. Going through that, you heard me use a term earlier, I used it last year as well, around building a battle-ready balance sheet. In March of 2021, if you go back and you read our first quarter earnings release for 2021, we laid out our general plans for how we would conduct ourselves for the next 2 years. We said in broad brush strokes, we had accumulated a lot of cash on our balance sheet. We were concerned that there would be turmoil and instability ahead due to rising and persistent inflation, and we did not want to take this pool of cash and redeploy that. We wanted to hold on to the cash and make sure that we were in a position now to be able to be aggressive whenever everybody else is fearful. That's how we like to operate. We like to go against the grain when it's appropriate and when it adds value for shareholders and customers and the communities we serve. And so we came up with this construct of creating a battle-ready balance sheet, and not to be too sophisticated, but four broad elements. One, we wanted to hold on-balance sheet liquidity. We don't want to be like our peers that took all this cash and figured out how quickly they could dispose of it to earn some yield. We wanted to hold balance sheet liquidity on hand. We wanted to make sure that our credit metrics were strong. We didn't want to go into a down cycle carrying a lot of credit baggage. We didn't want a lot of bad loans. We didn't want past due loans. So we focused on cleaning the book and keeping it clean. We also focused on making sure that our deposit base was stable and low cost. You heard me say earlier, we used the temporary money to allow some CDs to exit the bank. We also exited high-cost municipal deposits. So all the school deposits, the county deposits, those are really great. We love serving those segments. The problem becomes they go to the highest bidder, and those get very costly. And that doesn't add value for our clients. That doesn't add value for our shareholders to pay more for deposits than we have to. So we use those excess funds to exit those business lines and to focus on building and maintaining really strong core balance sheet strength. And last but certainly not least, capital is a key element of that. For us, having real tangible equity capital, the same way you measure your own personal net worth, real asset values minus real liability values equals real net worth, is what we were focused on. Regulators, if we're talking about regulatory capital, they actually allow you to add back unrealized losses. So there's some flaws in those numbers, and we were concerned about that on the front end. So our target was always to maintain high tangible equity capital, not just high regulatory capital, because our thesis was that those assets would decline in value. We wanted to have real value for you as shareholders. And last but certainly not least, having a team of individuals that can actually execute on this plan. When you think about reconstituting a deposit base and helping your team members and your clients understand how you're doing that and why, that's a tremendous amount of work. So David Thomas, who's our Director of Retail Banking, our market presidents, Mac Rushing, Jimmy Conyers, Grant Walker, who's not here, the entire team worked tirelessly to help re-educate our staff around that. To be able to have the sort of organic loan growth we've had, 15%, doesn't just happen by accident. That was a huge effort on the part of so many people, from our Chief Banking Officer, Greg Hodges, to the same individuals who I've just mentioned a few moments ago. And last but certainly not least, to have the ability to plan, to forecast out for a bank our size and say, hey, these are the numbers we need to hit. Here's the roadmap to get there. It takes a tremendous amount of intellectual horsepower. And so our Chief Financial Officer, Casey Hill, our Chief Operations Officer, Jeff Trammell, enabled us to execute on building this battle-ready balance sheet. And it's been a 2-year process. It's not a switch you flip and you get there overnight. There's no quick way to do this. With that being said, let's talk a little bit about high level, where we are from an asset size and what this looks like, right? If you're looking at this from a shareholder, Clayton, I hear you saying the words, show me the numbers, show me the money. So 2019, which is the last pre-COVID year, that's the last normal year before all the fiscal stimulus, you will see a pie chart that reflects our total assets on the left. The pie chart on the right shows you what our balance sheet looked like post-COVID, and you'll see the huge increase in cash, and you'll see a big decrease in securities. The reason that happened is the government is hyper efficient at one thing: refinancing their debt. They're really, really good at refinancing debt. And not just the federal government, but state governments, municipal governments, school districts, they're all really good when rates come down at refinancing their debt. So we had a securities book, and whenever rates were bottomed out, all of our bondholders refinanced their bonds at lower rates. And so again, we found ourselves in a position where we had this cash and we had to decide, what are we going to do? Decision point, flashpoint. Do we do what everybody else is doing? Do we do what we've done in the past and just reinvest that cash and get some income? Or do we hold the cash back and hedge against the risk of rising rates? Rising rates that may put our bank in the same spot that so many are in today if we had followed conventional wisdom. Suffice it to say, we elected to hold the cash back. So if you fast forward to 2021, you'll see that cash grew to 25% of our total balance sheet at year-end 21. Huge amount of cash for our company, and it stayed there throughout the bulk of 2022. It's important to note that while our year-end data shows the cash decline to less than 5%, we had a very significant amount of bonds mature on January 1st. So literally, cash as of January 1st was more than double that number on January 1st, and we have additional bonds that are maturing here in the next 60 days. Our securities portfolio is really short in general, and it's by design so that we can avoid those risks. But if you're looking at what that looks like to maintain robust on-balance sheet liquidity, that's what it looks like in graphs. The trade-off, of course, is if you hold cash, you earn nothing on it, right? It's a trade-off. So that is the key reason that our earnings have been down over the last couple of years, is that our revenues have been down due to holding cash. I mean, that is the why behind that. Now, for illustrative purposes, I thought it would be interesting to show you what we would be looking like had we followed conventional wisdom in 2020 and said, hey, we have all this extra cash. Let's just do what we've always done. Let's do what all of our peers are doing, and let's reinvest that cash back into treasuries. Let's do that. So where we're sitting at as of first quarter, and we filed our first quarter earnings release and call reports that's out there, we have about $12.5 million in unrealized losses in the investment portfolio as of Q1 of this year. Had we followed conventional wisdom back in 2020, had we done what so many other banks did, those losses would be 6 times that amount. We would be sitting somewhere near $73 million in unrealized losses on our balance sheet. And what that translates to is a loss of liquidity. Yeah, we could sell those investments, right? We could sell those, but then all of a sudden those paper losses become real losses and they erode your capital. And so that is the flip side of the decision we made. We did not go down this path because we were very concerned about the impacts. And so that's number one, to maintain liquidity and to focus on capital. The second prong of this battle-ready balance sheet I mentioned is focusing on credit quality. This is a long-term graph of several credit quality metrics within our bank. You'll see impaired loans graphed out. You'll see other real estate graphed out. You'll see loan loss provisions graphed out. A couple of things I'll point out. Our loan loss provisions for 22 were relatively low. We had a fully funded allowance. We have a model that we run on a quarterly basis to make sure that that allowance is adequate based on the credit risk in our portfolio. The other important thing to note is you will see impaired loans tick up slightly at year-end 2022. However, it's important to remember that if you're comparing those back, let's go back to 2017, right? It looks like, well, impaired loans are now back to where they were in 2017. As a percentage of gross loans, it's less than half. Our gross loans have grown such that impaired loans as a percentage of gross loans at year-end 22 is about 1%. So 1% of total loans are impaired, and that's actually come down during Q1. If you go back to 2017, when that level was about the same, that represented more than 2% of gross loans. So as the bank has grown, as the balance sheet has grown, as the loan portfolio has grown, the relative credit quality has gotten better. It also bears mentioning here that on January 1st, our company, and we talked about this in the earnings release, adopted a new model for reserving for loan losses. It's the current expected credit loss model. Fundamental shift in how banks nationwide account for potential risk in the portfolio. Based on that model, based on regulatory guidance, we took a one-time transfer from retained earnings to fund a larger allowance. And so in broad brush terms, our allowance for loan losses grew from being around 1% of gross loans at year end to being more than 2% of gross loans as of January 2nd, based on that allocation. So from a peer standpoint, our allowance is now far stronger than most of our other peer banks by a wide margin. And we were able to do that in a way that did not impact net income because of the one-time transfer from capital that was prescribed by regulation. So as you're looking at this now, not only are impaired loans lower as a percentage, but our allowance to absorb those loans is more than twice as large as it was ending 2022. This is another lens to view credit quality. If you're looking at the trends of 30 to 89-day past due loans, people who aren't paying, non-accrual loans, non-performing assets, you'll see that those trend lines are all downward. And it's very important to us that we maintain really good credit quality going into the cycle that we're in. We're not sure what the future holds, but we know that maintaining good credit quality is largely within our control. So a lot of work by a lot of people to make sure that those levels not only have obtained these lows, but that they've maintained them for the last several years. And again, that's not an accident. That takes a lot of hard work on the parts of a lot of folks. I'm looking at Lisa Jones, who's our Director of Lending Services, and she and her team in collections have done a phenomenal job. We literally have no other real estate on our books. That's one of the first times the company's ever had no foreclosures in its history. Really remarkable. Beyond that, I know I touched on capital being an important piece of our battle-ready balance sheet strategy. As a reminder, in 2021, shareholders approved us participating in the Community Development Financial Institution program called the Emergency Capital Investment Program. Best way I can describe this is like a paycheck protection program for banks like us that are CDFIs. As a CDFI, that means we have a mission-oriented focus. We aim to serve not only those affluent clients, but we have a huge focus on serving communities that need help, low to moderate income communities, majority minority communities, small businesses, people that don't need a handout, they need a hand up. That's baked into our culture. That's who we are. That's who we've always been. And so that allowed us to access a one-time opportunity to bring onto our balance sheet a tremendous amount of capital. We did close on that in June of 22. That netted us about $50.5 million in non-cumulative, perpetual, non-voting preferred stock. For the first 2 years after we received this money, there are no payments required at all. No interest accrues, no payments are required. And thereafter, these preferred shares, beginning in 24, will carry a maximum lifetime rate of just 2%. It's an insanely cheap capital. Generally speaking, banks have a cost of capital north of 10%. So for us to be able to bolt on $50 million at a 2% cost of capital all in, maybe less, that really changes the calculus. And from a shareholder standpoint, that gives us a tremendous amount of fuel that we can grow from. It gives us a tremendous buffer against the current economic instability. As you'll see, we did inject $20 million of that down into the subsidiary bank. We still hold $30 million of this, give or take, at the holding company level. But it also provides us a lot of opportunities to continue being stable and supporting the communities that count on us. And I'll tell you, there are many individuals that if it weren't for Merchants and Marine Bank or one of our ancillary divisions giving them a chance to get a loan, they wouldn't get it. They would not get it. And I would argue that if we weren't here, many of the communities that we call home around Jackson and George County would not be as vibrant as they are for lack of access to capital. That's who we are. That's what we believe. With that being said, let's talk about income. This is a pretty exciting graph to look at here. You have long-term income trends going all the way back to 2010. So our year-end net income for 2022 was just shy of $3 million. If you read the annual shareholder report, our cover letter from Royce and I, we gave you a graph of a J-curve. Anytime you make large-scale investments or anytime that you implement a turnaround of a company, you expect a J-curve. You expect net income to go down and you expect it to increase. You'll see that in fruition in that graph that is in the report. For instance, of the nearly $3 million in net income that the company reported for last year, $2.7 million of that was earned in the second half of the year alone. Just putting that in perspective. That was not a one-off flash-in-the-pan trend. I want to point out that if you annualize our first quarter net income and annualize that out, we would actually be earning north of $4.6 million. We think that number is very realistic. Frankly, I think we will probably exceed that number as we go through this year based on the fact that our net interest margin continues to expand at a time that most other banks' margins are contracting. You'd be interested to know that, in fact, your company's net interest margin is in the 90th percentile of our peer group at the end of first quarter. So we're literally in the 90th percentile, top decile performance based on our core profitability as of Q1. And again, it goes back to that strategy around the battle-ready balance sheet. We held back the cash and we only deployed it when the timing was appropriate to do so, so that we could create significant improved performance for the long haul. This is the J-curve mapped out for you to include first quarter performance. So what you'll see here is cumulative monthly net income. So this builds on each other month over month. And I'll say that in February of 22, as planned, the company actually had a slight loss, but that has improved radically. And you will see that line sloping ever upward and frankly more aggressively upward as we get into 2023. The light blue shading is going to denote income from this calendar year. Okay, so that is 2023 monthly net income that is sloping upward. We're really excited about this, and again, we think this is a trend that will continue. To address a topic I know that's on everybody's mind, it's on our mind. I'll tell you that a significant chunk of my personal net worth is tied up in the bank stock, and it's not because I get options or grants, it's because I believe enough in it to, take my money and buy bank stock, and the same is true for our directors and our executives. I want to talk a little bit about stock performance. Dr. Lewis did a good job discussing where the banking sector is. This is a look back on how Merchants and Marine Bancorp, MNMB, compares against the BKX, which is the KBW Bank Stock Index. That stock index is an amalgamation of 24 bank stocks, regional banks, that's designed to give you an overall view of the performance of the industry as a whole, right? So I know we sit here and say, man, the stock's still at $40 or $38. Gosh, what's going on? What's wrong? Dr. Lewis even commented, it's insanely low priced compared to the performance of the company. But I think it's important to take into account the impact that the industry as a whole is feeling. If you had invested $1 in the BKX Bank Stock Index a year ago, you would now have 70 cents. To put that in perspective, it's lost more than 30% of its value. And that's an index that's meant to mirror the industry as a whole. Whereas if you had taken that same dollar and invested it in Merchants and Marine Bancorp, the stock is down slightly from when I pulled that at the end of April, but you would still have most of your dollar. It would not have eroded. Plus, you would have dividends added to that. Our dividend yield at current values is north of 3.6%. And I will tell you, the dividend is very important to us. That dividend has been consistent for more than 78 years. We've never suspended it, we've never cut it, and that's a remarkable track record. But that's what it looks like if you're comparing us against peers. Now, our goal is never to be a bottom performer. Our goal is never to compare ourselves against banks that are not doing that well. But the reality is the industry as a whole, based on the bank failures that are going on, and even as we sit here, there are banks being discussed that will likely fail. The industry is not being treated very favorably from a trading standpoint. So, Clayton, what are you going to do about that? What is the team going to do about stock performance? Let me walk you through what we have been executing under and broad brush strokes of what our plans are going forward. So first and foremost, what drives stock price is consistent growth in earnings per share. I'd love to say it's dividends. It's not. In fact, research shows that there is no corresponding increase to stock price that accompanies an increase in dividends, period. You can increase dividends, but statistically speaking, stock price will not go up. Now, what will happen is the converse. If you cut dividends, on average, there's a 10%, give or take, a reduction in stock price. That's why dividends are so important to us. We don't want to cut those. The plan is never to cut those. But the focus has been on controlling earnings per share. So we have first invested in getting the operational and management infrastructure where it needs to be. Many of the banks that are failing today, Silicon Valley Bank, Signature Bank New York, and others, they grew rapidly by 60%, 70% over a very short period. And I think you could argue pretty well that they did that in absence of having the operational and management infrastructure to control it. So first and foremost, we built that out. We built the operational infrastructure ahead of growing. We built a foundation that we could grow from comfortably. We also got the right people on the bus and got them in the right seats. I know that sounds cliche, that sounds simple. That's really hard in community banking, to get the right people trained up in the right seats and keep them there. It's very challenging in our environment. So first we began with that, and then we began focusing on developing really aggressive long-term financial plans. Plans, frankly, that many of us were sitting around thinking, man, it's going to be really hard. I don't know if we can get there. But we set aggressive plans, and we began working toward those and building positive momentum. There's a lot to be said for a group of people that believe in their ability to hit goals and objectives. If you set really aggressive plans in front of a group that's motivated, that has that self-belief, they'll hit the plans every time, or they'll outperform. Think of someone like Brad Cornett, who more than doubled his loan growth goal last year. It was just phenomenal what Brad Cornett has done for our team. But it's because he has the backing behind him. It's because he has the belief in himself and the belief in his abilities, and it enables him to perform at a high level. From there, we began focusing on how do we diversify our revenue. We know that certain channels of revenue are under attack, and so that led us down the road of creating new divisions. Let's diversify away from being a traditional net interest margin bank that depends on service charges on deposit accounts. So we were fortunate enough to recruit Jonathan Shows and at the time Sharon Rice to help us launch Canvas Mortgage. Canvas Mortgage was never built to tap into the refinance boom that was happening a couple of years ago. We knew we'd miss that. But long term, that functions as a hedge for us for when rates do go down. We now have a fully staffed mortgage department with operations that span from the Eastern Shore through Baton Rouge, Louisiana, and some of the most vibrant housing markets in the Gulf South that we can tap into when rates do go down. And they're treading water now, and that's great because many mortgage companies are having to lay off staff, and they're not in that position. We're able to grow alongside of Jonathan. We also have Joe McNeese, who handles all things operational for Canvas, and Terry LeBlanc, who handles all things sales and recruiting. So they have a dynamic team there that also led us down the road into a couple of other divisions that I'll touch on momentarily. But beyond that, what I'll say, and you'll hit the other things, core earnings and size and scale. Things I want to say is it's really important to us that we follow through on what we said we were going to do. If you go back to that first quarter earnings release, there's some big promises and some big plans. And we knew that we would be judged not by what we said, but by what we did. And if we made big promises, we knew we had to follow through. And from an investor standpoint, if you have the confidence in the management, if they set out aggressive plans and then they can follow through, that gives you the ability to continue in believing in them and continue investing. And so we focused on the things we can control. Now, can we control what the industry as a whole is doing? No. Can we control what our knucklehead peers did with investing short-term deposits, long-term? No, we can't control that. Can we control the amount of liquidity that's out there for our stock? Can we convince people to sell their stock? No. We've tried. I mean, I've tried to get people to sell me their stock, and sometimes they don't want to. I wish we could, but it's not always possible to do that. So we have focused on controlling what we can control, telling our story, setting big plans, following through, being bold, being aggressive, and trying to do that in a time when others are fearful so that we could develop the track record to enable a foundation to be built for long-term share price appreciation. There are some things that we can control related to trading volume. For instance, henceforth, our executive team will no longer be trading across the desk. So what that means is in the past, if you came and said, Clayton, I've got 100 shares of stock, do you want to buy them? We'd sign that transaction across the desk. We're no longer doing that. That will all be routed through market makers because if you look at the stock trading volume, there's not enough volume there. There's trading that's going on that's not being reported to the market. So we are shifting away from that, and we're going to lead by example and say that going forward, all of our transactions are going to be open market transactions, purchased the same way that anybody would buy any other publicly traded stock. That helps the company through reporting that volume. That also helps us avoid any sort of future judgment about impropriety. Now, we've always purchased those at market value, but again, we're trying to go ahead and put those disciplines in place ahead of growth. We don't want to grow into FDICIA compliance or Sarbanes-Oxley compliance requirements and not be ready. So from there, I'm going to hit through these key accomplishments real quickly, but before I do, I think we got a quick video for you.
The years leading up to 2022 challenged us all. But throughout, Merchants and Marine Bancorp kept our goals clear and compass steady. We steered into exploration and opportunity. We saw growth on the horizon. In 2021, Merchants and Marine Bancorp grew our brand family in the industries we touch through the launch of Canvas Mortgage. We continued that momentum in 2022 by launching CanaFirst Financial to serve an innovative market in Mississippi, and Voyager Lending to help small businesses in the Southeast soar. We grew our service footprint, opening and breaking ground on new locations in downtown Mobile, Hattiesburg, and Baton Rouge. We grew our influence, taking the story of this historic community bank and its values to Texas, Tennessee, Missouri, and beyond. We grew our skill sets, earning prestigious leadership certifications and board seats. And we grew together as a team, making investments in our communities and in each other. Where will Merchants and Marine Bancorp grow next? With 120 plus years of service and vision to build on, we're just getting started.
Let's talk about what we've accomplished, and I'll try to recap what's going to be in the video. First and foremost, I'll touch on this theme again, battle-ready balance sheet. It's going to be something you probably get tired of hearing me say, but it's going to be the key to our success, and it has been the key to being in this position of strength thus far. That was not easy to come by. It will be very important for us to maintain that as we go forward. Growth and diversification. So you heard me talk about Canvas Mortgage earlier. We were fortunate enough to launch 2 new divisions last year to help us continue growing and diversifying our revenue and providing greater stability to income. Let me talk you through these. First was CannaFirst Financial. As you guys know, 74% of Mississippians voted for the legalization of medical cannabis. It is legal in Mississippi, tightly regulated, very tightly regulated. And as we began watching the developments in this space in early 2022, we kept waiting for a large bank to enter the space and say, hey, we're going to do medical cannabis banking, and nobody did. Well, on the way, we were interacting with more and more entrepreneurs who are well-funded, who have really solid backgrounds, who are entering the space, and they didn't have banks to accept the deposits. And so we spent a lot of time and did a lot of soul searching to figure out if we had the ability to create a program, an ecosystem to allow these medical cannabis businesses to operate in a way that's safe and that's compliant with all federal laws. Now, the challenge with this is cannabis in any form is federally illegal. It is legal at the state level. Banking laws and regulations do allow us to handle these accounts, but the level of scrutiny, the level of compliance, the level of monitoring and analysis that's required to do this in a way that satisfies all those regulations is mountainous. It is not easy to do, and ultimately we realized that's why many banks were not getting in the space. They didn't want to deal with the onerous regulations. We were fortunate enough to be able to recruit a team to help us build an ecosystem from the ground up and find the right partners to build that. And so we have Kia Malady, who is our director of operations, sitting over there in the green shirt. We also have a new team member, Liz Liker, and really the brainchild behind this has been our chief operations officer, Jeff Trammell, who still serves as the managing director of CannaFirst Financial. Why this adds value for you as a shareholder. One, CannaFirst Financial operates as a digital bank. I know we all hear, oh, fintechs and digital banks. You should know that your company now has a digital bank in the form of CannaFirst Financial. We were the first bank to offer cannabis banking services in Mississippi, and we have clients all across the state of Mississippi that bank with us through this digital channel. It also adds value to you because it's a great source of zero-cost deposits. Back to Dr. Lewis's comment, there's lots of money floating around that has no safe home. This has allowed us to bring in additional liquidity, and it also has allowed us to bolster non-interest income because for these accounts, they're not your average small business account that has no service charge. There are hefty service charges that accompany these accounts, not to be punitive to the clients, but to help us cover our cost of operations and to return a profit to us that's commensurate with the amount of risk we're taking. So that's the thesis behind that. I'll tell you that it's been incredibly well received in the Mississippi medical cannabis community. Our brand is really well known. That brand is trademarked, by the way. So if you're going to go out and Google CannaFirst Financial, just know that is a division of your company. That's a division of Merchants and Marine Bank. And we're thankful to have the team we do. We also, one of those people that you'll probably see bouncing around with a lot of hats is John Parker, who serves as the Director of Sales for CannaFirst Financial, as well as a team member in the Legacy Bank brand. So we're fortunate to have the group we do making this system work. The most recent new addition to the Merchants and Marine Bancorp family of brands is Voyager Lending. So again, another opportunity to diversify our revenue base and to enter a market that really aligned with who we are as a company. We love small businesses. We want to do everything we can to support small business. The challenge has become that regulations are so tight. You heard Craig say earlier, regulators have been really focused on the asset size. Hey, bank, you can't make the loan to this business because they hadn't been in business 3 years and you don't have 4 years of tax returns and they don't have 25% cash down. But not making those loans hurts our community. Somebody's got to make those loans, and we'd prefer it not be a hard money lender. So we were very fortunate to be able to recruit a team away from another bank, a very capable executive team led by Matthew McKelvin. I'm not sure where McKelvin is. We also have Kaylin Summers, who's the Chief Credit Officer of Voyager Lending. We have Joanne Hill, who's the Director of Operations for Voyager Lending. They all operate out of the Atlanta metro area. So again, thinking about the digital bank construct, we have another platform that functions in essence as a digital bank. It's very niche focused on SBA lending and government guaranteed lending like USDA. The team resides in the Atlanta metro area and they cover everything from Texas through the eastern seaboard. We do have, I see Dennis Tynes here. If you're looking for SBA help locally, we're fortunate to have Dennis Tynes as a business development officer for Voyager Lending who covers the Gulf South. Dennis lives in Harrison County. So if you have anybody that needs SBA support, USDA support locally, we have a guy. Give us a call. But if you see Voyager Lending, again, know that is part of the Merchants and Marine Bank family of brands. That's a part of your company. It's not just some out there sort of company. All right, as we go forward to 2023, and I'm getting really close to wrapping up, first and foremost, we're going to maintain the strength we built in our balance sheet. I will tell you there are lots of opportunities emerging as more and more banks find themselves on hard times. We're getting better opportunities to look at loans. We're getting better opportunities to look at buying other banks and franchises, but we're being more vigilant and more disciplined now than we've ever been because of the market conditions. Holding on to our position of strength as we go through what will probably be a tumultuous 2 years is our key priority. And we will do whatever it takes to hold on to that position of strength to make sure that we don't sacrifice what's been built by the hard work of so many. We're also going to continue focused on divisional growth. So not just adding additional new divisions, not trying to dream up additional constructs, but first and foremost, helping each one of our divisions all the way from the flagship brand, Merchants and Marine Bank. Coincidentally, if you exclude all the divisions, the bank brand itself is hovering around a 1.15 ROA right now, just to put that in perspective. And even with the divisions, we're still about 75 basis point ROA through first quarter. But help each of these divisions continue growing into their own, first and foremost. Secondly, we are always open to additional opportunities to expand, but those opportunities have to align culturally. It has to be a team that aligns with who we are. They have to align financially. It can't be a pie-in-the-sky notion, some crazy harebrained idea that's unproven, and it has to be something that aligns with our mission as a CDFI. We're not just chasing every opportunity. We're very selective on what opportunities we have. But suffice it to say, if the bank is as profitable as it is now, the company consolidated is as profitable as it is now, even with some of these divisions still being in their infancy, we have a very bright future ahead as they blossom into maturity. We're also going to continue focusing on talent acquisition and development. Hint, hint, school people that are here, high schoolers, hint, hint. It's very important for y'all to know that our industry has done a horrible job developing talent. There is a massive gap in talent in banking right now, and it's so evident in so many areas. So we have realized that it doesn't help us to go across the street and pay somebody 10% more to come to us because we create mercenaries. We create bankers that are hopping around for a little bit higher pay, and they hop here and they hop there. And instead, we've gone back to the good old-fashioned build your own bankers mindset. We're doing that across the board. I'm thinking of someone, Randy Ween, who recently joined our team, who's in our Lucedale market. Randy has no direct banking experience. He came to us from a sales environment, is doing really great. I also think about Reese Fleming sitting on the back row, who's our BSA officer. Reese came to us as a summer intern back in the day, and Reese has been in the company 12, 13 years and has grown from being an intern and a teller to being over all things fraud and money laundering for our company. That's what we're focused on, because if we can control this supply chain, if we have the ability to build our own bankers, the stability and the strength that provides this company is astronomical. There is value in that. So that is a key focus for us, and it's something we're really passionate about. And Greg Hodges, who's our Chief Banking Officer, is leading a lot of those developmental efforts along with Cheryl Wolf, who's our HR Director. We're also going to be very focused on building out, continually building that operational infrastructure. So again, the lesson learned from the banks that are failing, aside from they mismanaged assets and liabilities, is they grew really fast and their operational infrastructure did not keep pace. We have built a lot. Our non-interest expense is higher now than it's ever been, and it's because we've built a really robust foundation to build from. We want to make sure that we don't ever find ourselves behind the curve from an operational standpoint. We want to make sure that we always have people that are more qualified than they need to be, who are better capable than they need to be, so that they can guide the growth rather than trying to catch up to the growth. So that's a key focus for us going forward. Not to mention the fact that individuals who are high performers want to be in environments where there are other high performers. And so along those lines, you guys, as we go through this, we'll see another logo. You'll probably see it displayed throughout the middle. It's a center of four interlocking sort of people, and that actually represents our new bank services division. So the newest company that has been launched by your bank is a bank services division that we call Community of Resources. That is comprised of all the back office functions that can not only support and that not only do support Merchants and Marine Bank, but they support all the other brands we have and the brands that we will have in the future. And so I'm looking again at Lisa Jones, who's sitting here, who's a part of that. Kelly Green is a part of that, who's our Director of Deposit Ops, and our Director of Technology and Integration, Bradley Bell, is a part of that. And all that funnels under our COO, Jeff Trammell. But again, we're focused on staying ahead of the growth, not trying to catch up to the growth.
Artificial intelligence that we hear so much about, taking over jobs and taking over people's minds even. I know it's going to be here, maybe not for me to see in the future, but it's coming.
That's a really, really good question, really interesting. And for what it's worth, it is impacting the way that we view our functions and our operations. I don't know that it's at a place that we would ever sacrifice individuals in lieu of AI, but we do think there's strong potential to leverage it to multiply the impact of our team. So let's say, for instance, we've got a team member whose job is completing complicated financial analysis and then writing detailed summaries of that analysis. Not sure that the AI can always do the detailed analysis, but when it comes to plugging in a few data points and having an AI-based system that's built around algorithms, completing a first draft of maybe that written work product, probably strong value there. We've also considered it from the lens of interacting with clients. There's features called chat bots that would go on our various websites and apps that would enable clients to get more real-time responses and even get responses 24/7, even when we don't have team members working. I will say, as we go about this, we have not fully deployed AI yet, primarily due to privacy concerns. So I do enjoy playing on ChatGPT. Our team knows that. It's fascinating what it will do, but I'm really concerned about who owns that data and where that data goes. And when it comes to our view of your personal data as a customer or shareholder of the bank, there's nothing we hold in higher regard. Making sure that that's always safe and that it's always under our control is a priority. And so I think that is probably going to be one of the limiting factors on how quickly we deploy that. And beyond that, I know there's a lot of discussion around the appropriateness of continuing to push this out and to what extent it does reshape the workforce. I'm an optimist. Casey is probably more of a realist. I would hope that this is probably going to be something more akin to the Industrial Revolution, in which everyone was initially fearful would make everybody jobless. We're going to have machines back in the early 1900s that did everything, right? Nobody would have jobs. But instead, we figured out how to coexist with the new technology to amplify the efforts and to create a better world and to create a better lifestyle for everybody rather than replacing them. I'm hopeful that's what the future for AI holds, but I do think there are a lot of questions over how it's being designed.
Yeah. Given that it was basically my job description that you gave at the beginning that you thought it might replace, I'm a little fearful now. I do agree with you, Clayton. I think I don't know that it's going to necessarily get rid of a lot of jobs. I think it will make people a lot more efficient at what they do, and when that happens, that efficiency through technology is a force multiplier for what we can do with moving assets to higher value uses over time, which is how wealth is created within the country. So I think long term, it's going to be a good thing. I think it, as much as I hate to say it, it needs a lot of regulation around it before we can get really comfortable with it.
Can you tell us a little bit about possible acquisitions, where we are right now, and do we have a limit as to where we want to go with acquisitions, distance-wise?
Sure. Terry, thank you for the question on that. So Cliff Notes, there are no active pending acquisitions at this time. I can tell you that we're very disciplined when it does come to the potential of growing through acquisition. We think there will be tremendous opportunities, probably very likely some FDIC-assisted opportunities based purely on the economic environment we're in. However, we have not found any that match that sort of alignment between the areas we're focusing on, between culture, between financials, and between alignment with our CDFI mission. We've had the privilege of looking at some from time to time, but there's just not really been any that fit that alignment. And in terms of a kind of a planned growth trajectory, let me begin by saying that Jackson County is home. Were it not for Jackson County and the individuals who thought enough of this company to reinvest and bring it back to life in 1931, which is an incredible story. Were it not for this home, we wouldn't have anything. However, our judgment is that in order for us to continue supporting Jackson County and providing the level of service we need here, we do have to enter new markets. There's no other way to do that safely. And so we're always looking at additional markets to enter. Ideally, for the first few, that would be within about a 4-hour radius of here. We wouldn't see jumping to California and buying PacWest or anything. You know, I'm not going to put that out there, but you know, that's anyway. I just thought that may get a reaction, but if they're reasonably close and they allow us the opportunity to diversify geographically, and if they allow us the opportunity to create a brand or save a brand, because that's our entire model, folks. We don't ever want Merchants and Marine Bank itself to become a cold corporate bank. I know we have those stories about why each of you bank in the bank, and it's because you can get somebody on the phone, a real person who can have real decision-making authority. And our path forward is not trying to take one bank and make it some big behemoth. Rather, it is putting together a family of brands, a family of banks. You know, we're taught in the Bible some really great lessons about diversification. We're taught there's wisdom in a multitude of advisors. We're taught that a cord of 3 strands is not easily broken. You know, I don't know that anybody looks at the Bible for economic advice, but it's there. And so when you take that into consideration with our strategy around diversification, how do we diversify? Our thesis is that we will be better served long term to create a family of community banking brands that can be hyper-local in their community, that can be the bank for their communities, but that share a really strong, outsized operational backbone that allows them to operate the same way with the same services, the same offerings that much bigger banks have, but just to be powered by that back office and not have that back office rule the way they interact with their clients in the communities. And Casey, I'd ask you to weigh in.
No, I think you nailed it. It's got to be the right partner, right? We've worked way too hard in the last couple of years to build the balance sheet and the positioning that we have today. And the biggest mistake we can make is get in a rush and give that away. So we've looked at a lot. We've gotten well down the road with a couple. And at the end, we discovered things that didn't really fit with culture or directionality or the composition of the combined balance sheet. And we're going to be very careful with the capital that we've been entrusted with.
I have several questions from the viewers online. Can you talk about the efficiency ratio and the low earnings relative to equity, and what steps management is taking to look more like peers? Also, please comment on the current environment impacting M&A, which I think you just covered.
Sure. I think that's a really great question. So I would go back to the J-curve that we've talked about. So if the viewer has the annual report, they could see the J-curve in the shareholder letter. We're aware that the efficiency ratio is high. It's high by design because we have built the operational foundation first. Again, back to the examples we're seeing of banks that are faltering today. It's those banks that had a really rapid growth without having the ability to control that growth. They didn't have the back office, they didn't have the people, the systems, the technology, and they didn't have the diversification. And those things are really expensive. I mean, I'm not gonna mix words about it. It is very expensive to build that the right way. But our focus has been building that operational backbone and getting that built ahead of growth, which is the inverse of a lot of our peers. Most of our peers go ahead and get the revenue, they get the growth, and then they figure out, well, how do we integrate this? We've gone the other way. We do anticipate as we go through the remainder of 2023 and really into 24, you'll begin seeing the efficiency ratio normalize. However, if you're talking about return on common equity, given the large amount of capital we have, or if we're just talking about ROE, and if we're rolling in the preferred stock into that, the amount of capital we have relative to our size is really large. For instance, we have enough capital to more than double the size of the bank today. I mean, and still be well capitalized under regulatory definitions. But we've just shown the ability and the willingness to hold that capital back and not just grow for the sake of growth, but to grow when it makes sense, when it adds value, and when it doesn't detract from what we're doing. So I would say that as we grow into the operational infrastructure we have, and as we can continue executing on our plans, you should see that efficiency ratio come down. The return on equity is probably not until we really grow into the capital we have.
Yeah, and that's a perfect analysis of the situation. You really need to look at us going forward under a return on common equity model, right? We've got that large amount of preferred shares out there, and that's going to allow us to maximize our return on common equity, on common shareholders. So with regard to the efficiency ratio, if you work for Canna First, Voyager, or Canvas Mortgage, would you raise your hand in the room? This won't do very much good. So probably 15% of the people in the room right now. Those companies have been established in the last 2 years and more weighted in the last year. Those are some that are just now getting to profitability. And even so, the legacy bank or the bank as a whole is making as much money as it ever has, right? We're doing that, to borrow Clayton's analogy. There is one place, right, in the Bible that has economic advice, and it was the three servants, right? One buried the coin in the ground, essentially, got zero return on it. One got a decent return, and one got a great return. Well, we want to take our shareholders' money, our master's money, and ensure that we're treating those shareholders fairly. And to do that, you have to have a long-term growth rate in your revenues above the market mean. Did I say that correctly, Dr. Lewis? And to do that, we have to continually invest these upward earnings in places that we think will continue to multiply those earnings upwards. And we think that these three extra divisions are that. They're all running ahead of budget. The company as a whole is running well ahead of our strategic financial plan that we published 1.5 years, 2 years ago. And I won't give specifics, but I will say that strategic financial plan has us in a place of really truly record earnings in a material way in relatively short order in the future. So that's why we're doing what we're doing. That efficiency ratio will cure itself over time as these investments come to fruition.
All right, a few more questions online. Has the bank considered paying director's fee in stock? I noticed, this person said, I noticed some of the directors own less than 200 shares.
Sure. So, and that's a great, great question. So our bylaws currently prevent us from using stock in any form for compensation. Our bylaws contain what are called preemptive rights. And so in essence, that means that there's no real way to use stock for incentives or for compensation in any form, be it for leaders like myself or even directors. So again, all the stock that is acquired by these individual directors is done in open market transactions. There is a minimum amount of stock under Mississippi law that's required to be a director of the bank. That's somewhere around $80 or 80 shares of stock. It equates to about $200 par value. But philosophically, beyond that, one really important thing that I'll point out is that for us, the selection of directors, and I need to give a lot of credit to Royce Cumbest and Tom Van Antwerp, our chairman and our vice chairman, respectively. The selection of shareholders has not been exclusively based on who has the largest holdings. Rather, it's been on who will drive the strongest value for all shareholders. How do we get the necessary subject matter experts and the necessary diversification on the board to lead to outsized results? And that's not to exclude large shareholders who may fit that mold and who may fit in one of those categories, but I can tell you the analysis we do when we're looking at nominating individuals for shareholders is pretty complex. We look at the makeup of the current bank, the expected growth rates, where our directors reside geographically, what segment of our current expected business volume is in different industries represented by our board, where we may have gaps or where we may have opportunities. And so there's multiple lenses that go into viewing the board from a nomination standpoint. And so I know that's a little bit more than maybe was asked, but Casey, I don't know if you have any thoughts on that.
No, it's most banks our size and larger have significant equity grants for executives and directors, both upon hiring and continually. We don't do that. And honestly, I have less shares here than I do at former banks, but when you adjust it for what I was given versus what I bought, it's significantly more here. And I'm pretty proud of that. And that's true for all of our executives and all of our directors. Everything that we own, we have purchased with money out of our own pocket. Nothing's been given to us. And we do that because we believe in where we're going. It's not just lip service. We've all got very significant portions of our net worth tied up in this. And I think some of those stock ownership numbers are probably old.
I think that may be. And so, Greg, another question I would kind of add on to that. I know in the past we've had the question, we were SEC registrants up until the passage of the Jobs Act, and we were able to deregister. And so as an SEC registrant, there are a lot of disclosures made because of SEC rules around compensation, equity ownership, and things along those lines. And while those exact disclosures are not made today, it's important for shareholders to know that if you're interested in what any executive officer holds by the way of shareholdings or directors, that data is available in a form called the FRY6. That is a publicly available document. If you have difficulty finding that, let us know, and we're happy to give you copies of that. That is published by the holding company annually. Typically, we turn that in by March 31st of each year. It's normally not made public by the Fed until later in the year. I don't know why it's delayed, but if anybody wants a copy of the year-end 2022 holding, we're happy to give that to you. Just see me or see Jackie afterward, and it's going to be available publicly anyway, but that is a tool.
This will be a challenge to answer quickly, but it's a good question.
It's probably any question for me.
Yeah, you're right. You're right. Let's fast forward to 2028, annual shareholders meeting. Where do you see Murchison Marine Bank 5 years from now?
Wow. I don't want to scare anybody, so I'll not know. No, I think we have the potential to radically transform in a positive way this company, to continue on the current path that we are, to have greater reach in terms of the impact we're having in the communities, to have far larger asset size, to have a far more dynamic and diverse leadership team driving it, not just at the bank brand level, but across all divisions and across all levels. The trend that we're on from a profitability standpoint and a growth standpoint is really impressive. And if that trend does nothing but continue, if the current trends that we've seen, an improvement in earnings, stability in earnings and revenue, growth of capital, growth of leaders in banking, we have an incredibly bright future. But I will say that from a geographic standpoint, we'll always consider Jackson County home, but we are very open to leveraging the strength afforded us by Jackson County to serve other communities around the region.
You did it. That was quick. All right, so another question from our friends online. Deposits are in the news, but credit issues always seem to come with a slowdown in the economy. How are you and your team preparing for future credit issues?
Sure. So I think that's a very astute observation. Deposits are the issues today. Credit issues will be the issues tomorrow. I can tell you that beginning 4 years ago, with the hiring of Jeff Trammell, who was then our chief risk officer before he was promoted to be our COO, we commenced a comprehensive overhaul of our credit risk management framework. The entire division under Jeff's leadership transformed. And so if you're looking at the way that we underwrite loans, that we analyze loans, that we handle loans today, it is much more appropriate for a bank that's probably $2.5 to $5 billion. That's what we've built out in terms of operational framework. And so that gives us a lot of confidence on the front end, booking loans, analyzing loans, that we really know what the risk is on the front end. And then the ability to continue monitoring those on an ongoing basis gives us great comfort over where the risk is on a long-term basis. A couple other thoughts I would add to that. I mentioned in the presentation that when we adopted CECL, our allowance doubled. So our allowance for loan losses is now more than 2% of gross loans. That's huge. That's huge for us. That's huge for any peer there. That combined with our really robust capital gives us a huge buffer to absorb any credit losses that's there that may have slipped past. I don't know that there are going to be many. The other thing I would say is that for the last 12 months or so, we have been dialing back things like loan-to-value limits. We've been asking for more money down. We have been concerned that you would have this sort of environment. And so not only have we never deviated from those fundamental credit standards that make banks successful for the long term, we've actually tightened those a little bit just to make sure that if markets react in ways we can't anticipate, that we don't get caught by surprise. Casey, thoughts?
No, I'll add just anecdotal evidence. The deposit issue has caught many, I would say a majority of our peers in a lurch. And because of that, their liquidity constraints are preventing them from making loans of any kind. So the loans that are being put on the books today are A credits, right? We're getting to pick and choose exactly what we want to load onto the balance sheet. And largely we're in the driver's seat on rates as well. And it's because of the way that the bank has been positioned over the last couple of years that we're able to do that. So the good news is that the really robust growth over the last 2 years, so most of what you see in the loan book today happened after Jeff was able to reconstitute credit underwriting and what we were looking at in risk management to pull onto the balance sheet. And then what we're putting on today is even above that, because what we're getting to pick and choose with what we're loading onto the sheet is pretty incredible. So I feel good about, knock on wood, but I feel good about our credit positioning going forward relative to peer.
Okay, a couple more questions online, unless we got somebody here. Okay. You spoke about the stock in stock trading in more traditional public avenues and getting credit for volume. My question is, do you anticipate reevaluating where your stock trades? Right now, you're on the OTC. Would you look to list on New York or NASDAQ?
I think that's a really good question. I would say that we're always open to evaluating different options, but we want to make sure that the cost, both direct financial costs, but as well as operational costs of being on those exchanges, are warranted by the upward trajectory that would be possible from the stock. So I think the worst thing in the world we could do is to think that we're better than we are, or to think that our story is more compelling than it is, spend all the money, spend all the time, go through all the hurdles, and now we say, hey, we're on the NASDAQ, and the stock doesn't do anything. That doesn't help anybody. That actually hurts you as shareholders because of all the cost and the time lost in getting on that exchange, not to mention the ongoing reporting requirements. And so if we're going back to the slide where I laid out our long-term financial plans, we're always open to that, but it's more important to us in the short term and midterm to make sure that our performance is top decile, top quartile at least, so that we're performing far better than peers, so that when it makes sense to do that, and it does make sense to go on those exchanges, we have the potential for upward movement rather than stagnation to offset the cost that will come with being on that exchange.
Nothing to add on that one. That was
good deal. And Greg, we may do one more just to be cognizant of time. So maybe last question. I would open it up to the group here too, if we have anybody in the audience that may have a question. And I will say for individuals who are asking the questions via CallRail, we're happy to respond back to those. If those individuals would like to send a note in CallRail, maybe with their email address and what their question is, we're happy to respond to those to get you your answers. And I would offer that up to any shareholder, be it someone in the room or be it someone who's watching on the screen. You'll find that Casey and I are very open, very accessible. If you have questions now or on an ongoing basis, don't hesitate. Let us know. Yes, ma'am.
Okay, I feel like I finally had to say something, but the battle between the regulators and the investors, not just stockholders, but banking people. You mentioned that briefly, and the issues. One such issue with the regulators, the fact that you have to report every time someone spends over $600, which to me is pennies. Is that adding to the cost of your job, your business, trying to keep up with the regulators, all the regulations of informing the IRS or whoever wants it?
Yes, ma'am. That's a really great question. I will say the cost of doing business for us, based exactly on what you said, we refer to it as regulatory burden. It could be the heightened enforcement of rules that have been in place a long time, or us having to retool systems to comply with new rules. It is a major driver of cost for us. It really depresses earnings, and that's one of the reasons that we've been so focused on trying to grow the asset base of the bank so that we have more assets and more revenue to offset that heightened cost, because the cost is coming regardless. So we either figure out if we're going to figure out how to out earn it and do it the right way, or if we're just going to continue dealing with a mounting cost that erodes earnings, that erodes share value.
Issues like that is the banking industry and our congressmen going to step in there and do better to support our banks? Not the big boys, but us, the small, what I call small, which is not very small. Is there effort going in that direction to say this is too much?
Yes, ma'am. We've and I think honestly that's where y'all can help us. When we interact with our congressmen, and we're very actively involved. I know Dr. Lewis has written numerous comment letters. We've been actively involved in engaging with our delegations across all states we operate in. And I would say it almost is like they expect us to say that rules are onerous, that it's too much, that it's gone too far, and they kind of expect that. They're almost desensitized. And I can appreciate that, because right now in this environment, they're saying, Silicon Valley Bank lobbied to have some of the rules unwound from Dodd-Frank that allowed them to do what they did. And so I will say that while they're immune to us and desensitized to us, hearing from someone like yourself who may just be a shareholder, who may not be a banker, that's a little more impactful, I think. They're used to hearing us say, hey guys, this costs us money and here's dollars and cents, how it impacts us. But I think they're a little desensitized. Sure.
If you're okay with one more, this is a great question that addresses some of our next generation kids here with us today.
Right.
So do you think that financially there's a bright look for our future generations? It was mentioned that the shape of our economy is bound to fluctuate. Do you think that we have enough foundation alongside our skills to keep our society thriving for decades to come?
Yeah, I'll go ahead and take a swing at that one, because I'm pretty passionate about that. Sorry, Casey.
No, absolutely.
But yes, I think we are blessed to live in the greatest country in the history of the world, in the United States of America. There's no country like ours. And while we will go through valleys at times, the future for the U.S. is incredibly bright. And I would challenge you, if you are the type of person who's willing to ask that question, who's willing to enter the fight alongside of us and say, hey, we need bankers who are willing to fight for their communities, who are willing to fight for their customers. It's not hard. This is not a glamorous job. I say that. This is hard. This is not a glamorous job. This is a really hard career. It's a hard profession. You have to be comfortable being uncomfortable. You have to be comfortable leaning into really difficult situations if you want to have an impact. But if that's something that motivates you, if you want to have an impact in the lives of people who trust you, if you want to have an impact in the lives of the communities you serve, and be able to look back on a career and say, you know what, I did that. I helped create that business, or I helped this nonprofit start, or if it weren't for that first loan that I made this person, that multi-thousand person employer would not exist. If that excites you, this is the perfect career for you. And I think that's what banking's about. It's not about reconciling accounts. It's not about counting cash. It's about changing lives and building stronger communities. And nowhere is that more evident, in my opinion, than in banks like us that are CDFIs, that are community banks. So if you're passionate about that and you want to learn more, talk to me, talk to Greg. Seriously, we need you. We need your help. The reality is we're not going to be able to do this forever. We're going to age out, right? It's kind of like Tom Brady. And I can tell you, I'm not going to be the Tom Brady that comes back for the encore or the Brett Favre. When it's time to go, you want to go out on the high note, and you want to have somebody that's better than you that you can pass the baton to. And I don't want to speak for Casey, but that's the goal for all of our executives. We want to find the next generation, get them trained up, get them fired up, and then unleash you to have a big impact on the world. So if that excites you, yes, please. We're hiring now.
And further, there's a question I think embedded in there about the trajectory of the country and our economy and things like that. I'll put it back on the person that asked that question, and on our younger people that are in the audience today. that's largely going to be up to you, right? The power to vote is a sacred thing, and it should be treated as such. And I encourage you to ask questions and not just to believe everything you hear. Do research. If something feels wrong, there's probably some validity there. Trust your gut with things, but let it lead you to a place where you're applying logic and doing research with the way that you exercise that very sacred right. And please always do, because the future of this country depends on it. And when Clayton and I and the rest of our team are retired, we're going to look to you guys to be the leaders to make sure that things are still going in the right direction.
Well, guys, I just want to say on behalf of myself and Casey, thank you all for the time. Thank you for the really good questions. I have to say, I think we've had more questions this session than we've had the last couple of years. We appreciate that. We like the questions. We love the back and forth. If you have additional questions afterward, find us wherever we are, or again, take us up on the offer. Write that number down, text your email address to us. We'd love to engage at any time. And y'all, we just appreciate the time. Thank you for believing in our company.
Thank y'all.
Right on.
Okay, that was quite a good session. Appreciate the participation there. It's exciting because there is, if you're committed to community and you enjoy working with people, this is a great endeavor. Okay, going back to our teller's report, we did receive shareholders represented by proxy was 857,569. That's 64.46% of our base represented. We had no shareholders represented in person. So we do have a quorum, and I will direct Jackie if she would go ahead and incorporate the report into your minutes, if you would. Okay, so we can now officially call a meeting to order, and next order of business would be to have Jackie read our minutes from the May 5th, 2002 shareholder meeting.
I move we waive reading of the minutes. Second.
All right. We have a motion and a second that we waive the reading of the minutes. All those in favor of that motion say aye. Okay, anybody opposed to the motion? Well, Jackie, you did well this year. Okay, our next order of business is to elect our directors who have been nominated. These are directors in Class 2. Those directors are Abe L. Harper Jr., Amy L. St. Pay, Alan K. Suddeth, and Henry G. Hank Targison Jr. So at this time, we will pass out ballots for those who would like to vote in person. If you would raise your hand, we can bring the ballots around to you, if anyone would like to do that. Did someone want a ballot over here? Apparently not. Okay. All right, then we will then total these, and we're going to do a short recess, and I'll ask Jeff Hammond and Jeff Trammell to cast our proxy vote. We'll be right back. Y'all would get those.
Good morning, everyone. Thank you, Mr. Royce and Clay, for the opportunity to serve. The votes for Abe Harper, 753,898 for, 0 against. For Amy St. Pay, 52,318 shares for, 0 against. Alan Suddeth, 751,618 shares yes and 0 no. And for Hank Torgerson, 754,474 votes yes and 0 no. For ratification of T. Lott as our bank's independent auditor, 841,054 shares yes and 0 no.
Great.
Thank you.
Thank you, sir. Okay. That resounding vote indicates that these directors are elected, and our auditor also is elected. So we appreciate the fine vote there, and we'll continue to rely on those gentlemen to help us direct our board, and very much appreciate their past experience and their past advice and the good job they've done for us. Before we adjourn, I would like to make one comment. We had one of our directors this week, Dr. Paul H. Moore, passed away. Dr. Paul Moore had served this bank in various capacities starting back in 1972. So he had over 50 years of service to the bank. He was a gentleman. He had a wonderful wit, and always gave us good advice. I used to have the occasion. He took an avid interest in banking. Of course, he had many, many interests. If you get a chance, read his obituary. He's a phenomenal guy. One of those Renaissance men, I would say. But we had some good times, and he worked with us through some rough times. And a large part of the growth that we've seen over this past 50 years, we talked about how after World War II, our bank really began to grow. And he's part of that process. He was very instrumental in that. So I know you all join with me in remembering him, and our prayers go out to his family. His service will be next Friday, the 12th, at First Presbyterian from 2 to 4, and then the service begins at 4. So, and with that, and if there's no other business to come before us, I'll accept a motion to adjourn. Okay. All those in favor of adjournment, say aye. Any opposed? Thank you very much. It's been a great meeting. And I think we're having lunch afterward. Is that right? Don't forget. No need to go home hungry.